Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Ryan McCormack, factor and core equity strategist over at Invesco, for a recap of weekly performance in the Nasdaq 100. And of course, Ryan, we have to talk about what happened with the Fed minutes and the response that the Nasdaq 100 had to what Fed Chairman Powell had to say.
Absolutely. So looking at the week, we saw outperformance. So QQQM and QQQ were up 0.62% versus the S&P 500, which was just about flat, and S&P 500 value down about 67 basis points. We saw a big jump on Thursday. That was following a negative GDP print that I think surprised some, but showed some pretty robust consumer activity. We did see consumer spending rise 2.7%. Of course, inflation kept pressure on prices, and we did see a pretty substantial gap in trade, right, where imports outweighed exports. But of course, most of the attention over the week was on today, which was Fed Day. And about an hour ago, it was announced that the FOMC raised its target rate by 50 basis points to 75 basis points to 1%. This is the first 50 basis point hike since 2000, and I think it's important to note that Chairman Jay Powell did note that ongoing increases will be appropriate. From the statement as well as the press conference, some highlights. Chairman Powell referenced COVID restrictions in China that could impact supply chain, as well as the war in Europe, as two sources of potential upward pressure on inflation. We got some more details around the balance sheet reduction. It's going to begin on June 1st. Fed's going to allow treasuries and mortgage backs to roll off the balance sheet at a rate of $30 billion in treasuries per month and $17.5 billion in mortgage backs for 3 months. And then in September, it will jump up to $95 billion per month, which was sort of the initial target that Powell introduced a few months ago. $60 billion in treasury and $35 billion in mortgage backs. Some quick highlights from the press conference. 50 basis points hikes for the next couple of meetings is on the table. A reiteration that the economy is well equipped to handle these rate hikes. But sort of the important news is that they took 75 basis point rate hikes off the table, something that the committee was not actively reviewing. And really at that point, we saw major indices turn kind of bounce from positive to negative. After that was said, we saw everything move pretty firmly into the black. So we're seeing pretty widespread gains across Nasdaq, S&P, and the Dow.
Yeah, Ryan, before we get into your second chart, I just want to talk about the balancing act that Powell and the FOMC needs to manage. They don't want the economy too hot. They certainly don't want it too cold. They're raising rates to tamper demand, which of course leads to this inflation. But you wonder at what point, how high can rates really get, right? Because we know consumer spend and what that adds to GDP. If rates start to impact the consumer and inflation doesn't tamper, then you have to start, worrying about a slowdown, perhaps unintended. So the balancing act that they have to perform really is not as easy as it sounds with just raising rates.
No, not at all. And then you kind of throw in some of the added language around supply chain in China, as well as the war in Ukraine. I mean, those are the things that the Fed can't control, right? That still has pressure on inflation. So it really is, to your point, a very delicate balancing act. And I thought it was interesting in the press conference, Powell started referencing a softish landing, right? It's sort of, I think from his perspective, with all of these different risks to inflation going around. I mean, this is a very difficult task that they're trying to undertake.
All right, and let's pull up your second chart here. Let's see where the performance was coming in over the past week.
Yeah, so over the past week, overweights to tech and communication services finally helped relative outperformance, or relative performance, I should say, against the S&P. Lack of exposure to real estate and financials helped, with real estate down over 5% and financials down nearly 1%. The big detractor was communication services, as we continued to see, consumer discretionary, as we saw continued earnings announcements over the past week.
All right, and let's wrap up with that, of course, Amazon and Meta.
Yeah, so I think when you look at kind of the past couple of weeks, it's a tale of two earnings reports. Meta, formerly Facebook, with the largest relative contributor to QQQ performance, stock jumped over 17.5%, excuse me, on Thursday following earnings reports. Beat EPS, slightly missed revenue, but the thing that investors were looking at was a bounce back in daily active users, and Meta delivered that at 1.96 billion after that unexpected slowdown in daily users the previous quarter. So stock was rewarded for that. On the other side, Amazon, largest detractor to relative performance after the company announced a Q1 net loss. That included a pre-tax valuation loss of 7.6 billion on its investment in the EV maker Rivian. I don't really think that was the main driver of the negative performance of the stock following that. Soft revenue guidance for next quarter between 116 billion and 121 billion, missed analyst expectations for 125.5 billion dollars. But one bright spot, of course, is the continued strength of AWS and the cloud. AWS sales topped 18.4 billion, representing 36.5% increase, and the backlog climbed near 70% to 88.9 billion. So still seeing that robust growth within AWS. But for the year, Amazon down 25.5% roughly through yesterday. Facebook down nearly 37% for the year.
Could be interesting. Some long-term opportunities there that could be one of those generational buys, Ryan. You never know. Thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.